Welcome to the Nichols Tax Update Podcast for April 12th, 2021, issue 21-15. This program is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and expert comments on hot topics. You are receiving it as a member benefit from the South Carolina Association of CPAs. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. I acknowledge the value always, in preparation of this program, of my subscription to Tax Notes Today, which is published by tax analysts, the preeminent source of information for tax professionals. I could not produce this program every week without Tax Notes Today. So what's in this edition? 8 topics that caught my attention as I read Tax Notes Today every day. More guidance on the employee retention credit. More guidance, right? A revised practice unit. You're going to find me talking about these practice units. And by the way, there will be a special segment in Spring Splash on practice units, what they are and how to use them. A revised practice unit on when a return position might be based on reasonable cause and when the taxpayer is deemed to have acted in good faith. Then we have IRS guidance on calculation of gain or loss from partnership distributions. It seems that we're all having trouble with tax accounting for partnership transactions, so I thought that we would include this. Reporting requirements on pandemic-related emergency financial aid provided to some college students. Colleges received grants. They were then to administer those grants to help students stay in school who otherwise would be required to drop out because of pandemic-related issues. There's information about various IRS letters. If you got a stimulus check, then you got a letter, a 1444 letter. We'll talk a little bit about those 4 letters and what they mean. Then a foreign tax credit carryback and carryover. It seems that more of us have foreign tax credits reported from a lot from our retirement plans, where we're taking distributions, a lot from our investments in mutual funds. Mutual funds are investing in not only domestic businesses, but also international corporations. And we get reports that have foreign tax credit, or we have business clients that have a foreign operation and they pay taxes in a foreign country, and we have foreign tax credits. We're going to talk a little bit about the carryback and carryover instructions. And then a fairly typical tax case where a father and son owned a business and they tried to slip a few things by the IRS and it didn't work. Just a reminder that it doesn't work. Maybe you shouldn't try it. And finally, the IRS defines a restaurant. Why? Well, you recall one of those recent tax bills, there have been so many I lost track. One of those recent tax bills said that I can deduct 100% of the cost of a restaurant meal if the meal is business related. If I am entertaining a client, if I'm dealing with an employee on difficult issues, then we can deduct 100% of our meal in a restaurant. What is a restaurant? We'll talk a little bit about what the IRS says it is. So let's get started. Tax Notes Today had an article by Kelly Taylor that caught my attention about Notice 2021-23. In this notice, the IRS expands on previous guidance. It was a 2021 notice. It didn't take long to need to expand on the notice because Congress made changes to the credit at the end of 2020 that apply to the first 2 quarters of 2021. Notice 2021-23 amplifies Notice 2021-20 because Congress changed the law and we need to update the notice. So there's the technical citation of the CARES Act, which was amended by section whatever of the Relief Act. You can read it. You don't need me to read it to you. That provides that an employer is an eligible employer with respect to any calendar quarter for which its gross receipts for that quarter are less than 80% of its gross receipts for the same calendar quarter in 2019. And that was okay when they passed the CARES Act. But time passed and Congress amended the CARES Act. So now we've got additional quarters that are covered by this 80% reduction rule. So for purposes of the employee retention credit for the first and second calendar quarters of 2021, the determination of whether an employer is an eligible employer based on a decline in gross receipts is made separately for each calendar quarter and is based on the 80% threshold, but it's based on that calendar quarter 1 year earlier. So for the first calendar quarter of 2021, you could use the first calendar quarter of 2019, but you also could use the first calendar quarter of 2020. All the notice does is roll the rule forward 12 months. Remarkable. Now the IRS has revised a practice unit on penalty relief. This is important. This Pen C001 revised on March 18th, 2021 is important. It is worth your looking it up. It is worth your making copies and talking about it. Maybe you have a lunch and learn on Friday with your staff. It's well worth the effort. This revision addresses the application of penalties and the potential two-pronged defense. My return position was reasonable. I had reasonable cause for the position, and I acted in good faith. This practice unit provides a lot of details on factors that should be considered when you're determining if reasonable cause exists. Now, as I studied this practice unit, and I did because it's really important, I realized it's really hard to separate the concept of reasonable cause from the concept of good faith. According to the practice unit, the most significant factor in determining whether a taxpayer has reasonable cause and acted in good faith is the taxpayer's effort to report the proper tax liability. Factors that are to be considered are the taxpayer's experience, knowledge, education, and reliance on the advice of a tax advisor, a tax professional. Reliance on that tax professional, however, must be objectively reasonable, having provided the advisor with all the necessary information to evaluate the tax matter. If your advisor's experience is limited to preparing 1040s, you can't ask for advice on a complex corporate reorganization and expect to rely on it. Further, and this gets to that point, the advisor must have knowledge and expertise related to the tax matter, and the taxpayer must have exercised the care that a reasonably prudent person would have used under the circumstances to make sure that the information provided is really understood, to make sure that the calculations and the assumptions made by the advisor are reasonable. You're still responsible for the outcome. In this case, the outcome is a return position. This is a practice unit. The IRS uses it to do what? To train their auditors and to determine whether they should think about assessing a penalty for failure to exercise for not having reasonable cause, and for failure to exercise good faith. If you know what their instructions have been, and you know what their training is, you can duplicate that training and be prepared to address issues on audit. I'm sorry, swallowed wrong. And another practice unit on a partner's liquidating distributions, Par T008, on March 23rd. This covers the tax law that applies to distributions and liquidation of a partner's interest in a partnership. There's nothing new here, but what's new is our concentration of clients who are doing business as limited liability companies as partnerships. So over half the questions I get in any week from you and your colleagues relate to accounting for some transaction in a partnership, admitting a partner, liquidating a partner's interest, borrowing money from a partner, loaning money to a partner, organizing a subsidiary as a partnership. All of these things are dealt with in the tax law but we don't have a lot of experience with it because we've been working with S corporations and proprietorships and C corps. The partnership was not the favored mode of doing business until a couple of years ago, and now the IRS is bearing down on audits, and we need to be prepared and we need to be properly educated about this. So for current and liquidating distributions, a partner will generally not recognize gain. Gain may be recognized on the distribution of assets that would produce ordinary income if they were sold. Those are called hot assets. So if a partner receives hot assets in a distribution or is deemed to receive hot assets, the partner must recognize ordinary income. The balance of the distribution is treated as a gain from the sale or exchange of a partnership interest and will generally be capital gain. So unless 751B is applicable to require recognizing ordinary income, the rest of the distribution is capital gain. For current distributions, a partner recognizes gain to the extent the money received is greater than his outside basis immediately before the distribution. This is for current distributions, not liquidating the partner's interest. A reduction of a partner's share of the partnership's liabilities is treated as a distribution of money. So if a partnership pays off debt, that's treated as a distribution of money, and you could have a situation where the partnership pays off debt, a partner is deemed to have received a distribution which is in excess of the partner's basis, and a partner has to recognize ordinary income because the partnership paid off debt. That's always a surprise when you tell the partners that there's ordinary income required to be recognized because they paid off debt. Now, a partner will never recognize a loss on a current distribution, ever. For liquidating distributions, however, gain is recognized to the extent money or deemed money distributed exceeds the partner's outside basis, and loss is recognized to the extent the partner's outside basis exceeds money distributed and the basis of any hot assets, ordinary income producing assets. A partner will not recognize a loss on a liquidating distribution if the partner receives any property other than money, unrealized receivables, or inventory. So if there is any property other than ordinary income producing property, a partner will not recognize a loss. This is a brief explanation of what's in the practice unit. Once again, use the practice unit to train your people, to train yourself, so that you are better prepared to deal with partners liquidating distributions and current distributions. The reporting of emergency grants to college students has caused some difficulty. There are 6 frequently asked questions, but what's happening is the IRS is updating the FAQs. So what we have are current FAQs, and look at the date, 3/30/2021. Anytime you're going to rely on frequently asked questions, make sure that you make a note of the date that those FAQs were relied upon, because the IRS may change them next week. So emergency financial aid grants under the CARES Act for unexpected expenses, food, housing, course materials, technology, healthcare, childcare, are not included in gross income. If the student applies to the college for a grant, and the college uses some of that grant money which was allocated to them for this purpose, and they give the grant money to the student may still claim education credits and deductions even though the expenses were paid with grant funds. So that's unusual. That's not expected, but that's the way it is. The college is going to be required to report qualified tuition and related expenses. But that doesn't mean that the student is required to account for them any way other than if the student paid them. So you want to consult the updated frequently asked questions before you determine the income tax reporting of any amounts reported to the student on a Form 1098-T, because the amount the student got as a grant is not taxable. Impact payment and recovery credit letters. Boy, the IRS Congress has created a lot of confusion. people are getting stimulus checks, they're not getting stimulus checks. Where's my stimulus check? This frequently asked questions for taxpayers who received a letter about economic impact payments and their recovery rebate credit. It provides information about the letters the IRS sent or will send and explains why some people got a letter and some people didn't. After each of the 3 economic impact payments is issued, the IRS has mailed or will mail a letter called a notice to each recipient's last known address. This notice, Notice 1444, provides information about the amount of the payment, how the payment was made, and how to report any payment that wasn't received. So first there's a Notice 1444, your economic impact payment. That was mailed within 15 days after the first payment was issued in 2020, and it alerted the taxpayer to look for the impact payment as a direct deposit in their bank account, or maybe you should have received a check. Notice 1444A, you didn't get your payment. You may need to act to claim your payment. If you didn't get a payment, maybe it was because you don't file a tax return. If you typically aren't required to file a federal income tax return, the Notice 1444A, which you did receive, tells you how to claim your economic impact payment. Then there's 1444B, your second economic impact payment. Unlike the first Notice 1444, the law that authorized the second payment gave the IRS more time to mail the Notice 1444B, so we don't know when you're going to get that. Then there's the Notice 1444C. Later this year, the IRS will mail Notice 1444C, your 2021 economic impact payment, and that's people that got the third economic impact payment are going to get that letter, and you should keep it with your 2021 tax information. The foreign tax credit carryback and carryover can be really complicated, and that's why I chose that artwork. This practice unit, that's 3 practice units this week on foreign tax credit carrybacks and carryovers, tells you how to determine an excess credit and limit basket or category by basket. Down at the bottom of this slide, baskets include general run-of-the-mill income, passive income, global intangible low tax income, foreign branch income, and treaty resourced income. All of those are separate baskets, and you cannot commingle the foreign tax credit, which is earned or which is created by income in one basket. You can't mix that with the income in the other basket. So you've got 5 or 6 baskets, and you're calculating 5 or 6 carrybacks and carryovers, and this practice unit tells you how to do that and how to report that on your tax return. A remodeling business cannot deduct their race car expenses. Andrew Mitchell Berry, Tax Court Memo 2021-42. Owners of a home construction and remodeling company can't deduct almost $122,000 in car racing expenses as an advertising expense. That's where they put it. Oh no, that isn't where they put it on their return. Well, these expenses were not necessary for their business. They were in the remodeling business, and they buried these expenses in construction expenses. They didn't isolate them. They didn't report them as advertising expenses. They were. This is a quote from the court, said we had to find these among many construction expenses. And then they had a picture of the race car, but there was no company logo or trademark on the car. And they raced as Berry Racing, not as their remodeling business racing, but as Berry Racing. So maybe we can claim a separate business. No, the court didn't buy any of that. The court refused to even consider the proposition that the racing activity was a separate trade or business because there was clearly no separate accounting. And this wasn't enough. These people were non-compliant. Their other compliance failures, get this, included not reporting $250,000 of gross receipts because they opened a special account for a construction project. A customer gave them $250,000 to start the rehabilitation of a building to turn it into condos. So the Berries opened a special bank account and put the $250,000 in that account, and they didn't report that as gross receipts. I don't know when they were going to report it. They took money out of that to pay the car race, some of the car racing expenses. They took money out of that to pay for meals, and you get the idea. These people were non-compliant, and whatever they got in TC Memo 2021-42, they clearly deserved. Finally, the IRS defines a restaurant. I looked for artwork, and a push cart for this purpose is a restaurant. If I take one of my staff accountants and we go for a little walk and we come to a push cart and I spend $7 for a couple of hot dogs, and we're talking about a client, we walk along, we eat our hot dogs, that $7 is 100% deductible after the most recent tax act, whatever they're calling it. So notice 2021-25 defines what a restaurant is. It's a business that prepares food or beverages and sells them to retail customers for immediate consumption. It does not include a business that primarily sells prepackaged food or beverages that are not for immediate consumption. So the brewery that has a tasting room has a restaurant. Now, that part of the brewery that bottles beer or puts beer in kegs to ship out, that the people that buy the cases of beer, those don't qualify for 100% deduction. But if I go into the tasting room, I think it's free there, but maybe they charge me so I don't do much. So I whatever I would pay for in their customer experience tavern is going to be 100% deductible. But if the employer has an eating facility on their business premises that's used to furnish meals that are excluded from an employee's gross income, that doesn't qualify for the 100% deduction. Here, you got to go to the special guidance on employee meals. And you got to go to employer-operated eating facilities that are treated as a de minimis fringe benefit. Those are special rules or under Section 132. Well, as usual, it's great fun. It was a little longer this week. Thank you for staying with me. And remember, please stay safe. We need all of us to get through this together.